Not so happily Evergrande after China on the brink. Hi, everyone, and welcome to another episode of Insights brought to you by Ainslie Bullion and the Gold and Silver Standard. Today, welcome back, Alex, who's been looking at a potential crisis unfolding coming out of China. You've been consistently predicting something was going to break one way or another, and now this might be part of that unfolding at least. So how are you going today, Alex?
I'm going very well. How are you?
I'm good. So looking at the news today, and this is one I wasn't really paying that much attention to, but that's always the case when it comes to crisis. It appears seemingly out of nowhere. And there's one that's brewing Evergrande. It's a situation that people may not be overly familiar with, but I know you've been looking at it in depth. So can you start off maybe telling us a little bit about what's going on there, who the main players are, maybe also a bit of background on the timeline of how this is all unfolded?
So I don't think this was what no one was expecting. Evergrande 17 months ago got put in a trading halt because they were not meeting their repayments on their bonds.
So
So
you're saying I just wasn't paying close enough attention, is what you're saying. Not that I shouldn't have been expecting it.
I was being polite. But so everyone did see this coming. But I mean, the timing of this and the escalation of this in the last month's been very interesting because it was Evergrande on its own before. Everyone was expecting there's Wanda and there's Country Garden, part of it as well. They were all expecting, this to almost be contained with Evergrande, but it's snowballing. So, the Chinese HY stock market at the moment. So that's the real estate out of Hong Kong is down 82% over the last 5 years. So property is collapsing. Everyone's known about it. But what's actually happened in the last month is on the 5th of August, Country Garden defaulted on a $22.5 million payment on $198 billion of debt. So
That's
that
a
payment,
pretty small payment.
yeah, you and I worked this out before we started today. 0.1% of the total debt they defaulted on. So it's looking pretty dire. Then Evergrande, so Country Garden is bigger than Evergrande, but has about 198 billion in debt, whereas Evergrande has about $230 billion in debt and is a bit smaller. So they've been in a trading halt for 17 months. On the 18th of August, they filed for Chapter 15 bankruptcy in the US. And then yesterday, they reopened on the stock market and dropped 87%, which doesn't sound like much considering they're bankrupt, but they'd already dropped 95% before that. So they're now down 99% and they are basically a penny stock. So they just have huge debts. They have unfinished projects everywhere and they're not selling anything. So this has all sort of happened in the last month. And China has been trying to stimulate this, stop their stock sell-off that's been going on. But their consumer confidence has just hit the lowest level it's been since COVID. So the consumers in China are very pessimistic. On the 15th of August, China lowered their 1-year interest rates. They asked very politely that funds stop selling. So if they're selling something, they're buying something. So they've also slowed down the rate of IPOs just to slow down money being used somewhere else, I guess. And then they've reduced the stamp duty the day before Evergrande opened, which is quite kind, really, because I'm sure there were huge losses for a lot of people that they can maybe get something back from. So that's all happened in the last month. So yeah, it appears that the Evergrande contagion that China was trying to put aside and hold off somewhere, it can't be stopped anymore. China's probably seen that and they're just letting it go now.
And
which
so,
is great timing,
yeah,
considering the world economy right now.
Yeah, there's a lot going on, to say the least. So I find this quite interesting because the narrative around China seemed to be one of, that they had the zero COVID policy for that long period of time. Then when it was opening up, it was, we're full steam ahead. It's all going to go really well. It didn't really play out that way. So now we've got sort of those big cracks appearing, and this is probably the first casualty. It's probably, we often refer to the Lehman moment as that cause of the financial crisis in the US and the Western economies, but this is sort of probably a similar scale happening out of the Chinese economy, from what I can gather. So how do you think this plays out from here? specifically in China, like that broader Chinese impact, but also does this leak into the world economy? Is this something that ultimately ends up being a domino effect that causes other things to happen around the world that we start to experience here, for example?
So we talk about the higher, longer thing that's been talked about all the time by everyone. Bonds are the issue. It doesn't matter. So going back to 2008 GFC, again, it was bonds being the issue. It was mainly mortgage bonds wrapped up from the US property market.
Yep.
Now, what happened in 2008, and we've spoken about this before, is risk premiums were non-existent. Just everyone was buying the debt because it had good returns, but the interest rates were high. So the risk premiums on a lot of things were sub 1%. So the returns look great, but when you're paying interest of 6%, it was terrible. So what eventually happened back in 2008 was risk premiums started coming back into it. Now, higher, longer, if these risk premiums keep coming back into the pricing of bonds. So interestingly, in 2021, 1 in 10 worldwide non-government bonds were Chinese property bonds. So I don't need to tell you who owns that. So I'm sure all the banks own it. I'm sure the government, they own government bonds with it. They've already got mark-to-market losses with the increase in interest rates, the decreasing bond prices, which right now is on its third year of reduced prices. The bonds have fallen for 30 years, which has not happened in the 19th and 20th centuries.
And so, you actually, just to pause you there, you pointed that out last week because there's a really interesting chart that you put in that showed total returns, which is where you add up the gain that you make on the bond itself plus the interest, and they were negative for 3 years in a row. And that's really unheard of, isn't it?
Yeah, well, it hasn't happened since 1929. I know that. I'm going to say that I think it happened in the 1860s. I think that was the last time it happened.
So it's not a frequent occurrence.
Yeah. No. So 3 years running, bond prices have been falling. Now we've got something where 1 in 10 bonds in the world are probably loss-making, probably don't have risk in there. So if they were to keep interest rates where they are, for example, and everyone goes, oh, probably not going to make much money out of Chinese property bonds at the moment. And actually look at the US government right now. Their deficit's at 32 trillion. How are they going to pay this back at current interest rates? Maybe there's a little bit more risk in there than negative risk, which you and I have spoken about on that previous chart. So there's probably some positive risk in the US government and government bonds right now. So if nothing is done, and if we hold for longer just now, but people adjust their risk premiums, well, payments go up and bonds continue to go down. So governments may be forced to drop interest rates, but that may not lower the bond returns. And then that means that bond prices stay the same.
And I'd like to dig a little bit deeper into this because I think to me, it's something that's become front and center of my thinking for the last few weeks since we've been talking about it. This idea that if interest rates continue to rise, bonds just don't make any sense as an investment here. And they actually don't make sense when you think about that risk premium that you're talking about. So if you should be rewarded for taking on that additional risk. The fact that you're not only not being rewarded, you're receiving less than the current sort of Fed rate makes no sense long term. It's clearly not sustainable. So to me, it's a bit of a difficult concept to get your head around, but one way or the other, that has to resolve itself. So we either have to see bond yields go up, which means bond prices fall, so that makes them a bad investment, or exactly what you just said, we have to see the Fed come in and other central banks as well, obviously, and start cutting rates quite aggressively. Now, the problem with, to make it all match up, the problem with that, as I see it, is we just had Jackson Hole last week, where you get the Fed and central bankers around the world coming together to talk shop. And the message out of that wasn't really overly convincing that they're going to move from this 2% target, that they're really going to do anything. The idea that I sort of took from it was, well, we're just going to sit here, possibly another rate rise on the horizon, which doesn't help anything. So how do you reconcile that, where we've got sort of statements coming out saying, we're staying to this higher, longer course, but what you've just highlighted, what we've just been discussing, the market's saying the complete opposite thing. It cannot stay there.
So you and I have spoken about it. It's taken me, I'm not great with bonds, I'm better with other things. So it's taken me quite a while to get my head around it, because right now people are speculating that bond prices are going to go up. There's this massive squeeze going on. Now, usually contrarian, what happens when most of the market does something, it usually squeezes the market the other way. Everyone knows that. It's a common reaction in financial markets. But then you've also got what's going on in the US dollar, where everyone is, I'm not going to get this the right way, but everyone is going the opposite on, I'm just going to say the opposite on US dollar. What it was saying was both things that are opposite are going to happen. So what if both do actually happen? And for both to actually happen, what if the US dollar does actually drop from here? So that's what everyone was longing, the US dollar.
Yep.
So, and that goes against bonds. So what if from here the US dollar goes short because interest rates drop in the US, but bond prices don't actually fall, so that squeeze that we were talking about doesn't happen? That is the only way that these two contrarian things in the market can actually happen. And what that long-term means is bond prices keep going down, and the US dollar goes down because interest rates go down, because there is nowhere left to go when this risk premium is actually priced into the market, whether that be government risk premium or junk bonds like the Chinese property bonds that we've got going on right now.
That's such an interesting point, because a lot of people argue that these things can't happen
simultaneously.
That's right, that they can't. But the models have been broken here, right? That's an important point to make. You could also argue that you don't get total negative returns for the last 3 years on bonds. And as you highlighted in that chart, that's what we've had. So at some point, you have to acknowledge that things are not behaving the way that they should be behaving. And maybe we shouldn't be that surprised. Like if you're going to go through something like we went through with COVID, where you just pump an unimaginably large amount of stimulus into the economy,
things break.
Things break, and we might not be seeing them break in the traditional way that we go, oh, well, we're expecting crashes that don't happen. This is why we're sort of in this limbo state. It can just be that you don't know the outcome because we've never done anything like that before, not at that scale.
And you can have two contrarian markets that should be behaving the way they should. So bonds go up, US dollar goes down. That's normal. But throw risk premium in, it doesn't have to behave like that.
Yep.
And to me, with everything going on, that's what it looks like. And that is now how I've reconciled it. That is how I perhaps think it could behave. And these bonds that are, same thing, we've got Chinese property bonds this time. We had US property bonds last time. This has happened before. And once again, previously, risk wasn't priced in.
Yes.
So look at China. They just dropped their rates, and they did that because of these bonds. So if that contagion comes into the US market on government debt, exactly the same thing can happen.
Yeah, that makes sense. And we're running a bit long, but I'm just going to throw another question in there just because it sort of popped into my head when we were talking about that. It's fascinating to me that with gold, so we're bringing it to gold, where we are in the market at the moment, we're approaching back up to those highs again. I was reading something about there being no such thing as a triple top, so that we've been there again, and the expectation that it maybe breaks through this time. It kind of makes sense, doesn't it, against the background of everything we've discussed here today, that you look for safety in that market, because gold sort of seems to me like it has a dual role here. The safety from the chaos, because clearly we don't know what's going to happen next because these models are sort of broken, but also purely on the debt side, that you've got that asset price inflation that comes out of that debt, and gold should be a recipient of that. So gold looks pretty good to me here. Is that how you're seeing it?
Yes. I'm a gold bull, so I prefer,
But just taking your gold bull hat off, like if you look at it against this background, right, like of what we're talking about, it kind of seems like the asset that is the play here, right?
Well, I mean, DXY looks like it's going to break down. Bonds are not looking safe. What are the safety assets? Well, they're bonds, they're gold, they're US dollar, and there's one more, which I'm not going to probably. Do you know which one it is? I don't. Anyway,
I was going to say Bitcoin, but I don't know if the vast majority of our audience will agree with me on that
one. No, there's another one that I'm just not going to get, but it's not Bitcoin.
Right.
But Bitcoin has its own market, and it doesn't behave too dissimilarly to gold in these sorts of markets anyway. But regardless, that's yet to be proven long term.
Yeah.
Gold, is shine. Looks like it's shining under the current market conditions if this continues.
I just wanted to throw that in there because it really does like seem to tick a lot of the boxes here, and it also feels early to me because sentiment isn't overly strong.
Yeah,
it all the counterintuitive sort of or the contrarian trades I'm trying to say are lining up for gold as well. I feel because you just don't have that. There's not that bullish feel about it. There's not people rushing the door down. It feels pretty good.
Yeah, US dollar if it drops, and bonds if they drop. Like I said, there's gold.
That sounds great. All right. Well, thank you for giving us all that background. Lots of really useful information there, and like tying it all together with this idea that really some of these models are a bit broken, but like you said, the key ones that we normally would run to for safety in this environment are sort of they're not really showing or behaving the way that they should. So it's something to pay attention to, and particularly keep our eye on this Evergrande situation as a potential catalyst overseas that doesn't always get the mainstream attention that it should because it's out of sight, out of mind. But these things can be contagion that spreads. So something to be paying attention to.
Absolutely.
Thanks for that, Alex. All right. Thanks, everyone, for watching. Remember, you can reach out with any questions or comments on the social platforms. That's us for today. We'll be back on Thursday with Sam at this stage to discuss all things markets and metals. Until then, have a great rest of the week, everyone.